Are you struggling to read market direction or unsure where to enter and exit your trades? This chart might hold the answer. What you're looking at is a perfect example of how professional traders use support and resistance in a trending market to make powerful, confident decisions. In this video, we'll break down this chart step by step, revealing how each support and resistance level plays a crucial role in guiding your trades. Let's begin our journey into clean price action trading. Let's start at the very bottom. Here we see a strong support level. This zone is where the market previously found solid buying interest. Every time the price touched this level, buyers stepped in aggressively. This repeated rejection creates what we call a strong demand zone. For many traders, this is the origin point of the trend, a powerful area where a new bullish wave is born. From this zone, we notice the market starts making higher highs, signaling the beginning of an uptrend. As the price rises from the strong support, it reaches a point where sellers begin to take profits or open short positions. This is marked as minor resistance. The market briefly pulls back, but notice it doesn't crash, it pauses. This is an early signal that buyers are still in control. Traders watching this know that if the price breaks this resistance, we may see a continuation of the upward trend. And that's exactly what happens. The resistance is broken. After the breakout, the same level that once acted as resistance now becomes support. This is what we call a support resistance flip, and it is one of the most reliable confirmations in price action trading. The market pulls back slightly and touches the previous resistance, now acting as a springboard for further bullish movement. This level proves to be a great entry point for traders who missed the initial breakout. It's clean, simple, and logical. Moving further up, the price reaches another ceiling, another minor resistance zone. The market again slows down, consolidates, and shows hesitation. This is natural behavior. Resistance areas like this often test the strength of the bulls. Will they push through or will they retreat? In this case, buyers remain in control. The resistance breaks and the market continues its march upward. Each breakout builds more confidence for trend traders. And once again, the broken resistance level flips into support. The market pulls back, tests the level, and holds firm. This continuous creation of higher support levels forms a very healthy trend structure, something all experienced traders look for. These minor supports act as breathing points for the market. Price doesn't move in a straight line, it moves in waves, and these waves give you low-risk entry points aligned with the trend direction. Now, let's talk about the major resistance level at the top of the chart. This area has been tested multiple times. Each time the market comes close, it gets rejected. This tells us two things. First, this level is being closely watched by institutions and large players. Second, there's heavy selling pressure or profit-taking here. A breakout above this level would signal extreme bullish strength. But until that happens, traders should approach this zone with caution. It's a battlefield. Before attempting to break that major resistance again, the price pulls back and finds support at a recent consolidation zone. This becomes our final minor support in the chart. The market forms a higher low, a very bullish sign. This is the market gearing up for the next move. It's showing buyers are still strong and sellers are losing control. Many traders look for bullish price action here, like pin bars or engulfing candles, to enter trades before the next breakout attempt. So how can you apply this to your own trading? Simple. First, identify the trend direction using higher highs and higher lows. Then, mark the key support and resistance levels, both minor and major. Look for support resistance flips as confirmation points. Enter on retests, not breakouts. Keep your risk low and your reward high by targeting the next resistance or support zone. This chart is a textbook case of how clean price action can guide your trading without indicators. Now let's continue our journey by analyzing another powerful chart example. This chart represents a ranging market, where price moves between clear horizontal support and resistance levels without a defined trend. You can immediately see that the market is confined between a solid support zone below and a strong resistance zone above. This type of structure is extremely useful for traders who prefer range trading strategies, where buying low and selling high becomes the core approach. At the very beginning of this chart, we notice two areas marked as preposition anchors. These are the early swing points that first establish the shape of the range. They show us where the market found aggressive buying and selling interest in the past and act like the bones of the structure. Smart traders often use these preposition anchors as reference points for future levels. It's almost like planting flags on a battlefield so you know where the action is likely to happen again. As price moves up, it repeatedly tests a horizontal resistance zone. Each time price approaches this level, sellers step in and push the market down. This indicates that large players or institutions are placing sell orders here, and they don't want price to break above. The more this resistance is tested without breaking, the stronger it becomes. It's a signal that this level is respected, and traders can confidently look for short positions or take profits when price reaches this zone. On the flip side, we have the support level acting as the floor of the range. Every time the price comes down to this area, buyers aggressively enter the market and push price back up. This confirms the presence of accumulation, where smart money is possibly buying in bulk. This level becomes a perfect zone for long positions, especially when confirmed with bullish candlestick patterns like hammer or bullish engulfing. Remember, this is not just a line, it's a zone of interest. This entire structure is what we call a range-bound market, where price oscillates between support and resistance. In such a condition, a very effective strategy is the ping-pong method: buy near support, sell near resistance. It's critical, however, to wait for confirmation. Don't blindly buy at the bottom or sell at the top. Instead, use price action signals, wicks, or volume changes to time your entries with more precision. Range markets require patience and discipline. If you look closely, you'll notice that at times, price moves slightly beyond the support or resistance, only to return back into the range. These are known as fakeouts or false breakouts, and they're designed to trap retail traders. Smart traders avoid entering trades impulsively when the candle barely breaks a level. Instead, wait for a clear close beyond the zone, or look for price to retest the breakout area before jumping in. False breakouts are a key reason why many traders lose money in range markets. Finally, toward the right side of the chart, we see the market breaks the support zone decisively. This is a strong bearish signal. The previous support, which had held price up for a long time, now fails. This often leads to what traders call a range breakdown, where the market exits the range and begins a new trend, in this case, a downtrend. The old support may now turn into resistance, and traders will look to sell any retest back to that level. In this kind of setup, traders have two options. One, they can trade the rejection at the range edges, entering on confirmation candles like pin bars or engulfing. Two, they can trade the breakout of the range, entering after a strong close beyond support or resistance. For breakout trades, always wait for a clean retest or significant volume spike. If you rush in too early, you risk getting caught in a fake-out. Remember, patience is a trader's superpower. Support and resistance zones work not just because of technical patterns, but due to trader psychology. When traders see price bounce repeatedly from a level, they begin to expect the same behavior in the future. This self-fulfilling expectation creates repeatable reactions. Buyers trust support, sellers trust resistance, and this creates the rhythm of the market. The more times a level is tested and respected, the stronger the psychological memory becomes. Support and resistance aren't just lines on a chart, they're battle zones where bulls and bears fight for control. Whether you're trading breakouts, retests, or ranges, these levels are your guiding light. Combine them with price action, volume, and market context to increase your win rate. If you master this concept, your charts will become cleaner, your decisions sharper, and your trading more consistent. Don't chase price. Wait for it to come to your levels. That's the key. In this chart, we dive deeper into how support and resistance are formed using swing highs and swing lows. Notice the multiple circles on the left. These represent swing highs. A swing high occurs when price makes a peak before retracing. These peaks are critical because they represent areas where sellers entered strongly. When price returns to these levels, they often act as resistance zones again. Identifying these swing points helps us draw horizontal zones that serve as reaction levels in future price action. As the chart develops, we see price forming several swing lows at the same level. This becomes a confirmed support zone. These repeated bounces show that buyers consistently defend this area. What makes this so powerful is that it wasn't just touched once. It was tested multiple times, and each time the market respected it. This builds trader confidence. Support zones with such repeated confirmations are often considered high-probability areas for long trades, especially when combined with reversal candlestick patterns. Now look at what happens when this support zone finally breaks. Price crashes through it and, on the way back up, retouches the same level. But this time it rejects. This is what we call a support to resistance flip, or SR flip. The level that was once protecting buyers now acts as a ceiling for sellers. This shift in role is crucial to understand. It shows us that the market has changed sentiment from bullish to bearish. Many smart traders enter short trades at this exact point, especially when the retest shows rejection candles. As price moves forward, this flipped level gets tested several more times, and each time it fails to break through. This creates a new dominant resistance zone, confirmed by multiple rejections. This behavior is incredibly useful for range traders, swing traders, and even intraday scalpers. When a level is tested again and again without breaking, it strengthens the case for selling near resistance, especially when the market isn't trending. These reactions reveal that institutional players are likely placing large sell orders in this zone. This chart teaches a vital lesson. Swing highs and swing lows are not just random peaks and dips. They are the DNA of market structure. Use them to draw clean support and resistance levels. Watch how these levels react when price returns to them. Combine them with breakouts, retests, and candlestick confirmations to build a complete strategy. Whether you're trading Forex, crypto, or stocks, mastering swing-level SER concepts will give you a real edge. Learn to see what most traders ignore, and your trading will transform. To wrap it all up, support and resistance, when combined with swing highs, swing lows, and price reactions, form the backbone of professional trading. Whether you're trading trends, ranges, or breakouts, these levels guide your decisions with logic and precision. You've now seen how price respects these zones, flips roles between support and resistance, and reacts to historical swing points. This isn't about guessing. It's about reading the story the market is telling you. Stay patient, trust the structure, and let price come to your level. And if you found this video helpful, make sure to subscribe to Financial Freedom FX, where we turn complex trading into simple, profitable strategies. Hit the bell icon, join our free community, and take your trading to the next level.